thank you all for joining us. It is fantastic that people have joined here today to talk flood insurance. I know it's a, at times, dry topic, no pun intended, but the implications of flood insurance, particularly for our area, Kurilpa, but also nationally, are significant. So tonight, really, I'm going to speak for a little while. We're going to do some introductions and some housekeeping and some elements. Then I'm going to pass it over to one of our esteemed panelists today, Professor Paula Jarzabkowski. She will take us through some of her work as an expert in flood insurance, what she sees across the world and in Australia about the evolution of flood insurance, where we've come from and where we might be going. And the other side, and I'm going to do some more proper introductions as we go, we have Leanne and Jamie on the line, both very experienced on ground. So Leanne is a body corporate, leading that really difficult place where body corporates have to navigate insurance and get it secured, and then have discussions with residents and unit holders and all the groups who have to understand flood insurance. And then Jamie on the call as well, who's a very, very experienced insurance broker and has worked in this area for a long time. So if I was to start with a couple of things, one would be, I just want to acknowledge we gathered tonight on the Yoga and Turrbal people, the Kurilpa of Kurilpa, which is our group, Resilient Kurilpa, which I'll describe in a second, is a reference, is an Indigenous word for the water rat, which is the area in which we gather tonight. So the Resilient Kurilpa, our organisation, has a deep connection to the First Nations of our area. For the purposes of tonight, we, Resilient Kurilpa, are an organisation based in the suburbs of West End, Highgate Hill and South Brisbane in Brisbane, Queensland, for those joining from overseas. The area has a history of flooding. And in 2022, we had quite a significant flood. And as a result, we built a network of organisations which focused on practical and educational works and projects for our community. And one of those that has grown out of the needs of our community is a growing base of knowledge and experience in navigating flood insurance. We as Resilient Kurilpa are not an organisation that provides insurance, nor do we provide insurance advice, but we are going to act and continue to act as an organisation that brings experts in these fields to our community to talk about what can be done, particularly tonight in flood insurance. Resilient Kurilpa actually has quite a few different projects. We are running a series of webinars. There's been ones on apartment building, flood risk templates, apartment residents. We are doing one on First Nations, as well as people with disability and access. And we are building more and more projects that you can find on our website, resilientkurilpa.com. We'll put it in the chat. We are building a huge knowledge base. And so this tonight is another recorded webinar for the purpose of building more information and embedding resilience in our community and spreading that resilience far and wide. So welcome all. Anything else from a housekeeping perspective? Those who are not speaking tonight, you will not have access to a microphone. So if you would like to have ask a question or check anything else out, please put your comments or questions in the chat. We'll be monitoring that, as well as the Q&A. There are two ways to do it. So those who are not speaking, you will not be able to unmute and largely not be able to use your video. So tonight, if I was to sum it up, the objective is a straightforward and practical information from a global insurance expert, an insurance broker, and an experienced body corporate on managing flood insurance needs, including self-insurance for apartment owners and body corporates. We are going to bring to you the experiences and researches of people who are our peers, who actually have developed insurance processes, have experience in the insurance markets and actually have sat down and worked through how will we insure our building for flood going forward. So this is one of those forums. And let's do some more detailed introductions. And I might introduce Professor Paula Jarzabkowski first, because one of the things she will do straight away is take us through 10 minutes of how has the insurance market come to this point, and why is flood insurance on everyone's mind at this stage? So Professor Paula Jarzabkowski is a global expert in the private-public mechanisms proliferating in the world to address the insurance protection gap. The insurance protection gap is a technical term for just what is the economic loss from events that do not have insurance. So in this forum we're dealing with today, it is fundamentally about the uninsured impacts of flooding. Paula is extraordinarily credentialed. She is a professor at the University of Queensland Business School. She's also at City College London. She's a fellow of the Academic of Management and a fellow of the British Academy. She's on an advisory group for insurance companies and a member of the OECD high-level advisory board on financial management of catastrophic risks. So we are deeply, deeply honoured to have you here tonight, Professor Paula, to set the scene. Why are we talking flood insurance? With that, I might hand it to you.
Okay, thanks very much for inviting me to talk with you. I'm just going to share a few slides because insurance is a little bit technical, and I think that it might be helpful to just have some way of giving you a few visuals through that, and there will be time to ask technical questions at the end. The work that I'm about to present to you has been developed from many years of research around the world, recently brought together in this book with my co-authors, where we looked at 17 different kinds of public-private mechanisms operating in 49 different countries to address the disaster insurance protection gap. So this problem of what can't be insured. So I know quite a lot about it. I can't offer you any silver bullets, but hopefully I can explain to you how we got here and what are some of the things we might be able to do going forward, as well as where you should be suspicious if people are offering you something too good, that sounds too good to be true. So to help understand this, and I'm sorry for those of you who already know insurance well, but I'm just going to briefly take you through how the insurance market works so that you understand why there is the problem there is. So we know that we have a component of disaster risk when we buy an insurance product. So you're buying something to protect your house against theft and, random things like, the dishwasher hose coming off and spraying a bit of water around your kitchen. But you also know that something bad might happen. So when you buy your insurance product, a component of that is disaster risk, and you are transferring that. This is a risk transfer chain, that risk of a loss. You as a policy holder buy a product from an insurance company and you pay them a premium so that if anything happens, they will pay the claim and you'll get capital to make yourself good after the disaster. That mostly works on what we'd call the premiums of the many pay for the losses of the few. So when we just have a few random losses, then normal insurance works well. But the problem with disasters is that they usually come, to a whole group or a whole suburb or a whole region simultaneously. And insurers aren't just holding money on their books for really big losses, because that'd be inefficient. So they might not have a big enough reserve for when, the sorts of things we saw in 2022. So what they do is buy a reinsurance product, which is basically insurance of insurance companies. And the reinsurers, when we have a flood, it's actually that money that gets triggered. So their insurance product triggers, and then they pay the capital to the insurer to pay the claims in Australia. So that's kind of what you're looking at if it's all working well. Now, let me explain to you why it's not working so well anymore and why that's probably not going to change in any short-term scenario. So the first thing is that insurers are required to price risk prudently. They're regulated, and they need to show appropriate amounts of that they've got the right amount of capital to pay for the losses that they might have. And that makes sense. We don't want to be like we've seen in some parts of, for example, Florida, where there are insurance companies offering under the rate. When the losses happened, they didn't have enough money to pay the claims, they went bust. We don't want that happening. So the way that happens is what's called risk reflective pricing. And it's also about kind of what's called actuarial fairness, which means that if you bring more risk of a loss, if you're likely to have a loss, then the price that you get charged should reflect the risk you bring to the pool, because you understand now that it's a pool of insureds paying for any individual claim. So those who are more risky should pay more. And we know that we already sort of see that in, for example, the way we charge early drivers, you know, P-platers, they pay a bit more because they're known to be a class of driver that brings more risk to the overall pool. So that's one point where the more that you have a flood, the more that you reflect risk, the more that your price goes up. The second thing that is that generally speaking, if you think about insurance as a wallet, we've got a wallet in Australia of Australian insurers, and we've got a wallet in the global market of reinsurers. Now, if you don't have many losses, then that wallet stays pretty full. And so you can keep, you don't need such a lot of money coming in to keep it full to pay for the losses. But when we get widespread losses and we get them frequently, which is actually the case in Australia, we're a disaster-prone country with a pretty high loss profile, then widespread losses means that wallet gets depleted more. The solvency requirements for those kinds of losses are higher from the regulator. Insurance companies have to show their pricing for the kind of high risk they've got. And then we all know that we're in a situation of inflation and of rising costs. And insurance is a promise for the future to pay whatever the cost is to rebuild at the time that your house gets damaged. And we know that after widespread loss, you get, you know, it's much more expensive to get builders, materials, etc. So all of that has made the cost of rebuilding more expensive and a lot more losses of these expensive a lot more losses for these expensive rebuilds. The global reinsurance market is exactly the same. You know, it's just a big wallet. Right now, that global reinsurance market is facing catastrophic fire already in California and the earliest hurricanes ever seen in the Caribbean. There's flooding in Texas, there's hurricane and flood damage in Mexico, and all of that is costing the global reinsurance market. So its wallet is also being depleted, and it's being depleted. They've got higher losses than they've ever had year on year for the last 10 years. So they're just going to charge more. So if you look at it like this, you see it costs more if you get a loss. It's costing more to fix it, and the wallet is depleted Australia. And then those who are filling the claims, their wallets being depleted globally. So when you put all that together with another thing called climate-driven uncertainty, which is, you know, it's much harder to predict the losses, then that all adds to this increases in premium prices that are not likely to go down because we can't fix any of those problems, right? We can't stop the losses, we can't stop the risk reflective pricing. So, and certainly the climate-driven uncertainty is increasing. So it's not going to go down under the current situation. It's not like, well, this is just a blip in the market, or, oh, it's just insurers being greedy. It's just the state of the market. So what are we seeing happening? Well, we're seeing a lot of uninsureds, people for whom insurance is just unaffordable. So those are the people who just don't have any payments towards the future disaster, and what we would call self-insureds. Those who are literally saying, well, if it's going to cost me 10% of my house price, or 12% or 20% of my house price, and that is not an unreasonable amount you're seeing nowadays, in order to buy myself a meaningful insurance product, that doesn't make sense. You know, it means that every 8 years I've basically paid the value of my house just to insure it. So you get the self-insureds who are starting to save money themselves for a rainy day. What happens after a disaster is some of those have nothing, and they rely on the government or other aid and hope that there will be enough in the coffers. And then there's the group of these self-insureds who have prearranged their funds, and they can use a mix of what they've got plus government and other aid to make them good after a disaster. Kurilpa is sitting in that group. 1 in 8 Australians, 1 in 8 Australian households is sitting in that group, and that's up from 1 in 10 Australian households in 2022. So we can see that that's increasing, and you're part of. Yay, welcome to the club. It's the club you didn't want to be a member of. Okay, so what is one solution that we see around the world that is genuinely effective in lowering insurance premiums? I want to show you this whilst also telling you we do not have this in Australia. It comes with some caveats, but it is certainly the most common solution for the problem we're facing, and it's increasing around the world. So governments can create an insurance or a reinsurance risk pool, and that's what our book is about. And what it is essentially government legislated, not-for-profit insurer or reinsurer that's there to offer insurance and make it affordable to those who are in this situation like we just talked about on the previous slide. So what does this actual thing do? Well, it can be an insurer pool. Sorry, my computer keeps doing weird things. Hope that's not happening for you. So it can be an insurer pool. So the insurers take your disaster money and they can pass that on to a government-owned insurer pool. That's what we see in New Zealand with Tokatu Ake, which is the Earthquake Commission. The first 120,000 of any insured property in New Zealand is insured by the Earthquake Commission. So that's one way you can do it. The other way is the insurers can take that money and instead of having to try and buy on the global reinsurance market, they can buy from the government reinsurance pool for the big losses. And that's what we've got in Australia for terrorism, and it's effective for terrorism. And we now have it in a smaller way for cyclone, the Australian government, the Australian Reinsurance Pool Corporation. Don't want to get into too many details like that. I just want to show you why do those actually work. Okay, so here's what is it that they do? They basically take that original principle of spreading the risk, so having a big pool of insureds and using the higher risk properties, the lower risk properties to subsidise the higher risk properties. So what you see is something like Flood Re in the UK. It's a flood pool and it takes £10 off every policyholder in the UK, puts it into Flood Re, which is a reinsurance pool, and Flood Re then uses that pot of money it's got to subsidise lower premiums for those in the high risk areas. So that's how it's able to bring the price down, by gathering a pool of money from everybody and then creating that as the kind of diversification against those who are at higher risk. That's one way, it's cross subsidy. The other is, and we see this in some countries, because if it's only flood, you've only got the flood properties. But if you have a multi-peril where you've got flood, cyclone, bushfire, earthquake, then you've got diversification. You basically create the whole society as a mutual. You take all the disaster component, and that means that you can suppress the price more because you've got a little bit of money for every one of those kinds of disasters. And you're unlikely to get a flood and a bushfire at the same time, although you could certainly get a flood and a cyclone. So that's another way that they basically do this. They spread the risk across the whole population, which an insurance company can't do because it doesn't have the whole population. So it works by counteracting the risk reflective nature of pricing. It basically suppresses price for those at highest risk. And that works best when it's compulsory, so you get a big pool of insureds. There's lots of questions about, is that fair? Is that not fair? That's not my job tonight to talk about that, although I'll certainly take questions on it. All I want to say is we know this can get prices down and keep people insured. It has pros and cons. I can talk about those if you want me to. But what I want you to know is we don't have one yet, so it's not going to fix your problem. Nonetheless, if you read my book, you will see that it's a very likely thing to happen here at some stage, simply because the conditions that lead to the creation of these are the conditions we see in Australia at the moment. We do already have a precedent where after about 15 years, they've now developed a cyclone reinsurance pool. It doesn't have the characteristics of compulsion or diversification, so it won't quite give you what you're looking for. And so I'm not saying that's a solution for you now, but I'm saying it is a possibility one will happen because there is a precedent and because it is a typical thing countries do when they face this situation. But meanwhile, what can and should you do anyway? So for starters, be a self-insured, not an uninsured if possible. Some people who say I'm self-insured actually mean I'm just uninsured. So really think about the risk you face. What did it cost you last time that you had a flood? What did it cost your body corporate? What did you need everyone to put in for that? Do you have some kind of reserving in the body corporate for that? Or if you're an individual or private homeowner, what are you able to put aside, and how does that relate to the possible losses that you will face? Because that will at least give you some feeling of control over what's about to happen if a disaster happens and I don't have insurance. So that's one point. The second point, and this is the very important point, even if there is a national flood pool, this is the most important thing you can do, which is mitigate the risk of damage and loss. And so there's lots of things, and I know that Resilient Kurilpa has developed a sort of suite of resources to think about how do you make sure that you get less loss and you get lower levels of damage when you do face a flood. That's absolutely critical because, one, it'll cost less to get back to normal. So if you've got things like, for example, the way that where you put your lifts and things so that your lift don't get burnt out, then even if the power's off and you can't use them for a while, when the power comes back on, you won't have to also replace those. That's a less cost. If you know that a flood is coming and you've got a 2-story place, get the stuff up on the 2nd floor if it's above the flood level. It's all a ways to cost you less to get back to normal. And anything that has lower damage and lower loss is also, it's quicker to get back to normal. And if you're not insured, you're not going to be entitled to temporary accommodation because insurance pays for that. So the quicker you can get back into your house or the quicker you get back to living in a normal way, the better for you. So you can never go wrong with this, regardless of insurance. But the other thing it's going to do, increasingly insurers are realizing they've got to find a way to price mitigation. It's very poorly done at the moment, and I have to say the links between mitigation and insurance pricing are weak links, but I believe they will strengthen, and indeed the project we're doing at the moment, looking at the Resilient Homes Fund, is trying to establish some of those links in a more robust way. Then when that happens, because you've already learned how to mitigate and because you can already show them what you've done, then you are a high candidate to get that better price. The other thing is if a national pool comes in, it will help you because the national pools are often now using these things as levers to enforce mitigation and responsible behaviour. The other thing is you should be an activist for the policy changes you want to see. If you're in a situation through no fault of your own where this is happening to you and you can't get insurance and you're doing all the right things, then the next thing, of course, is be an activist. Try and get the policy changes that will make sure that you have the opportunity to, benefit from trying to protect yourself. So I'm going to stop there. I know a lot about insurance. I could go further. I could, and I'm happy to deal with any technical question, but I think I'm kind of out of my time and it's time to hand back.
Thank you, Professor Paula. A speed dating of the flood insurance market. So definitely those who've gone through this might have to get the recording and go back on a sort of 0.5 speed to enable us to understand all the concepts that just got handed.
Let me just give you one more thing in that case.
Go.
Here you go. Let me put this slide up. If anyone wants to read about it in detail, and believe me, this is not a difficult book to read, but it still does require some knowledge. Scan the QR code. The e-copy is free. We got a grant from the European Union, so if you scan that, you can have that for free, and then you can read it at your leisure, but it's probably quicker to listen to this recording.
Perfect. We'll put the link for that as well, both here and within the recording, so that you'll be able to get it. So the way I sort of saw this going was Professor Paula was going to race us through what the concepts, what the issues are. And I really now want to go straight to Leanne Sturgis, who's an experienced body corporate, lives in Kurilpa, has dealt with insurance, has dealt with 2 floods, 2011 and 22. I want to get your on-ground experience right here, because I think that's a really powerful way to sort of augment and highlight some of the issues that Professor Paula has shown, but also we're looking at what is a body corporate facing? What are you facing today, Leanne? Talk us through it.
Thanks, Sebastian. And thank you, Professor Paula. That was really, yes, a very quick but very interesting overview. It explains a lot of things much more clearly, even though we lived through it. It's another side of it that makes it easier to understand. So, yes, we have where I live. Our apartment building has been through the 2011 floods and also obviously just the 2022 floods. But when we had the 2011 floods, we didn't know what to expect. So we were, the water was coming. We just didn't understand. And they kept saying it won't get to the 74 flood levels. So, of course, You know, everybody thought, well, we're above the 74 flood levels, we'll be fine. Of course, that was a totally different flood because of all the infrastructure that's been built along the way. And, you know, we didn't understand that it would be a different type of flood and where it would come from. We learned a lot of lessons then. We learned what our risks were. We learned where the water came from. We learned what we, you know, the hard way about lifts. And once we got to there, so basically between, you know, the parts of the building that were damaged and the body corporate communal property, you know, it's probably in the vicinity of about, back then, about the $1.5 to $1.6 million worth of damage. And so, you know, people had to pay for themselves to fix what was of theirs, and then we had to levy then also the owners for the common property part. So you all had to pay an extra levy because there was no flood insurance, so to speak, because it has the technical thing that comes through that it came from the river or dam or wherever, so it was excluded. So what we did moving forward was we thought we'd come up with, start putting down some guidelines for ourselves, and we started a very basic flood mitigation template that we would follow and things that we would actually do to mitigate our losses in the next time that this was going to happen. So 2022 comes around, and that's exactly what we did. Just prior to 2022, the February of 2022, our insurance policy for the building came due in the September, and we got notified from our insurance brokers that nobody was offering insurance. For flood. We had actually worked with our insurance broker before then. We'd done some self-insurance and putting some money aside, built up a little sort of, you know, a buffer zone, and we actually got flood insurance. We had a sublimit to start with, a $1 million sublimit, or $500,000, then a $1 million, then a $2 million sublimit. And then in the last couple of years of our policy, before the 2022 floods, we actually had an unlimited flood insurance. 2021 September comes around. Sorry, we're not offering that. We're like, what? We've had it. We've got to this. Why are you taking it away? No, not offering it. Whether they had a crystal ball and knew we were going to have these climate events in 2022, maybe. But so what we did was straight away, we did a risk analysis. We sat down with our insurance broker and we had a risk analysis done on our building, and he was very impressed and said, hey, this is a great plan you've got here. It's, you know, but you really can't prove what your losses are going to be. You know, how do you know? The only way that this will probably work is when you have a flood, and then you can prove how much it cost you to get, you know, how much it costs. And we said, okay. So then what we said was we went to our AGM and the committee put forward saying, let's start our self-insurance for our uninsured events levy. Start saving that little bit along the time for what may come in the future. Thankfully, we started it and we raised about $100,000 in that first round of our year. And yes, 2022, a few months later comes around and we were flooded. What we did in that time was we did follow our plan and we did mitigate our losses a lot. So our losses came down to about $80,000. So very different flood, didn't flood as high, but we knew where we had to protect, what we had to protect, and all the things that cost big dollars. And we actually, of course, had a different type of flood and where, you know, how it came and how high it came. But we did do all of that preparation. And it was all voluntary. Everybody, all the owners, all the residents that lived in the building got down there, cleared our basements, turned our building back around very quickly, and we were able to use that uninsured events levy that we'd raised to essentially pay for that event. But we could prove at that time, we knew our risks, we knew what our costs were. So our hope is now that we can now start to move forward with our brokers to say, hey, we've got a plan, we know what's going on, we can look at our risk and say if we get to here or to here, this is what it's going to cost us. And we've even got further mitigation than, you know, that our lifts and things we can do to protect those as well. So, you know, you can take something from, and I'm talking, you know, 2011, which is, you know, 13 years ago, to 1.5 million down to, you know, under 100,000. So it's doable.
Yeah.
So yeah, that's the sort of the big picture, but, you know, very, you know, condensed version.
Well, it's such a powerful example of everything Professor Paula talked about: mitigation, actually understanding the risk, driving through with good risk templates. But it also shows you that the insurance companies, while they're open to mitigation, really need to see the evidence before they can change your risk profile from that perspective. I think that really drives through to Jamie, our final panelist. Jamie is an insurance broker for almost 22 years now, helping small, medium, and large businesses find affordable insurance, including body corporate. You've worked with Leanne off and on through this process, Jamie. Talk us through how, from your perspective as an insurance broker, how Professor Paula's kind of characterization of the market is occurring or not, and then the work you've done with Leanne to sort of ask the questions, okay, how can we secure reasonable insurance for a body corporate with flood exposure?
Yeah, thanks so much, Sebastian. So, yeah, that's really good order. So, you know, Professor Paul has done a great job explaining the fundamentals of how it all works from start to finish. So, you know, how premiums are pooled, how they are paid, what benefits the consumer, and how that all clicks. I think that was a really great slideshow and explanation on insurance in general. So, you know, well done, Paula. Leanne's just given, again, a very quick snapshot on when an event does occur by being proactive before that event. And this is the, you know, the very, you know, important part. It's a bit too late when it is too late. You know what I mean? That's why these meetings are going to have a lot of relevance at some point in time. When that time is, I don't know. We don't have a crystal ball. But yeah, it's very important to strategize now how to protect yourself moving forward. So from an insurance broker point of view, and I guess why we're still around today, let's be honest, the direct market is there. People can use the direct market. They don't have to come to us. We're a market that is, we're an industry that is still very much alive, if not thriving. I think what people have learned, especially, businesses that are in the mid-market and corporate areas, what I mean by that is they have, declared values in buildings and companies that are 80, 90, 100 million, 250 million upwards. They are the ones that have experienced some catastrophic losses in the past and have learned from that and brought in experts, insurance brokers and insurance advisors. We do one job, but the value of what we do is our resources extend beyond what we do. So, for example, if we are to look at doing a body corporate schedule or policy, we would first send out a surveyor, and we would attend with that surveyor. We would look at all the possible exposures that this building is going to represent at the time of loss. Now, a surveyor, just like Leanne said, a surveyor can't give you dollar for dollar what that looks like. We don't know until it happens, like Leanne said, and then you do know. However, what you can do with the surveyor is get a real time, and a real understanding of what that loss could look like. My job then is to provide, obviously, the insurance as a commercial insurance broker. Leanne talked about something called a sub-limit. For those that don't understand what that means is, if I have a total sum insured of 100 million, a sub-limit is a small amount of that total to cover a specific loss. So, for example, $2 million sub-limit means that if I have 100 million in cover, but a sub-limit of 2 million, if a flood occurs, I'll have $2 million for flood damage specifically. That is something that most insurers, like Leanne said, up until recently would happily provide, because we had not had a flooding event for the better part of a decade. We seem to find we call them soft markets in my industry, when premiums go backwards in the commercial space. that only happens when there's been a prolonged period of time of no major catastrophic losses. The current ratio in Australia, I think at the moment, and Professor Paula, you can pull me up on this if I get it wrong, I think our current claim rate's sitting at about 70%, which does highlight, the disasters and, catastrophes that we do have here in Australia compared to some other companies. So yeah, getting good advice, chatting to an advisor, and being proactive and do these things before the disaster, not when or after, is my only sort of take home.
I mean, Jamie, there is a role here just for body corporates coming up the curve on what their insurance actually looks like. I mean, Leanne in many ways has talked often about body corporates don't even open their insurance product and actually look at what they're covered until the water's coming through the door.
Yeah.
I guess, Leanne, maybe I could cut to you, provide some more information on what it is like as a body corporate with the time pressure, the voluntary nature of it, the complexity of it. Like, how do you actually get a body corporate to engage with what its insurance policies?
Yeah.
Looks like?
Well, it's difficult because it's obviously a legislative requirement. You must have body corporate insurance. Body corporate must provide insurance, and it's just, where body corporate committees are made up of voluntary people. They're not experts in any. They don't have to have qualifications to say you can come on the body corporate because you're an insurance expert, or you're a builder, or you're an accountant. You don't have to have any of those. You obviously have strata managers who will provide all of that guidance and, admin and accounting. And this is where the insurance part of your duties and your legislative requirements is being handled, because obviously the committees will change. Could be yearly. If you're lucky, you can get people to stay for a long length of time. It's a very busy job being a voluntary body corporate committee member, and again, it's voluntary. So if you sell, you can't be on the committee anymore. So you moved on. So you've got those committees are changing all the time. So clearly that knowledge or that transfer of knowledge doesn't always happen. So this is something like you can't just start a bank account and then next year it's a different bank account. You've got to have consistency. So that's what a strata manager will do and provide. And this is where the insurance has fallen, or not fallen, but has become part of their responsibilities to provide that. So your strata managers usually will work with brokers or insurance to ensure that your body corporate has, or your building has insurance. So that's just like a tick and flick. Have we got insurance? Tick. Got insurance. Have we, we've got a bank account? Tick. How are we collecting our monies? Tick. It's one of those tick things. To understand your insurance policy, you really do need to talk to the broker or get a broker and separate it and say, you know what, we're actually going to take this out of our strata managers channel, and we're going to liaise directly with the broker to look at our policy. And that's what we did after 2011. We came to the company that Jamie is here representing tonight as well, and we said to the broker, we're not happy with the policy that we've got. What have we, can we have a look at it? And he came through and did exactly what Jamie said. And what was really quite scary, it wasn't just about flood insurance we weren't covered for. There were lots of things we weren't covered for. Big machinery, we've got big ventilation, exhaust fans in our basement, big motors, they weren't covered. So here we are thinking if we burnt down, we'll be fine. We would have been covered for those things. So they specifically look at what you've got and your equipment and what you need to insure. And our policy changed dramatically to make sure we were then covered for all of those things. So that was one, positive step that came out of, I guess, doing that exercise. But then it meant that, we were working with them. And yes, that's a busy job as well. But I think if your committee has, it's engaged in knowing about the insurance to make sure that you've got the cover is right. Don't just assume, even things like, oh, we won't accept the CPI increase this year. Building costs go up. So there's lots of things that you have to understand. And by working directly with the broker, they're the experts in it. Your strata managers will help you, but that's given to someone within their department that is probably very good and works very hard with the insurance section. But the broker is the one that, they're the ones who understand that, intimately. So that's where you have to really focus on saying, as a body corporate, making sure you just aware of what's covered and are we covered adequately, and let's do the exercise. You might find you are, and that's great, but we weren't. And that's, working along and seeing what can we do to improve. The risk of getting it wrong is probably much higher than your risk of getting it right if you just do the exercise. And they'll talk to you about what else you can do to mitigate your losses generally on insured things, not even the uninsured like a flood, the insured things like, flexible hoses and services that, like Professor Paula said about, your kitchen, your dishwasher thing blowing up, and then you're flooding 2 apartments underneath you. They're all things because of as buildings age. So, be proactive, talk about what's going to be the reasons that might, have claims, and then do something about them on a whole body corporate scale with your building to bring those premiums down and bring your risks down and keep your premiums and your excesses reasonable so you can afford them. Owners, individual house owners as well as bodies corporates, need to be more proactive in the way that they manage and maintain their buildings. The more you let it run down, the more you let it get out of, aging and don't fix these things, you're going to have those risks. Your premiums are going to go up. Your excesses are going to go up accordingly. It's going to become unaffordable, not only because of the catastrophic events of the world, but because of the way you're managing it as well. Mm. So there's 2 parts to it, and you have to take that. It's just part of your due diligence, really.
Yeah, so it's expectations of that of the body corporate being an active member. Paula, I want to reference, there's a question about reserves and about premiums changing. This isn't a linear process, these companies dealing with these, as you say, 3 levels, the risk pricing, the wallet at the Australian level and the cost of the Australian level, the wallet and the cost at the global level, plus climate. There's going to be this volatility in premiums. Like, talk us through that. Like, there's this sticker shock that's occurring now when people are looking at their premiums are like, oh my God, it's $400,000 a year for a $1.2 million house. Then tomorrow they might get someone to come along and says, actually, there's it's been a big drop. We've had this change. So how do people, I guess I'm just asking, what are your thoughts on this volatility of premiums?
Mm-hmm. Yeah, so look, it used to be a feature of the insurance market that the longer you went without a loss, the more that your premiums went down. It was called the market cycle, and it's very much what's called, as Jamie said, a hard and soft market. There's a market cycle. That cycle has actually been pretty much smoothed out for a very long time. What we're seeing now, which people would say is a hard market and, it'll come back down again if we don't have losses for a while. Part of what we did, and we actually studied the global reinsurance market for about 5 years and wrote a book in 2015 on making a market for acts of God, is that actually that's not really so correct anymore because of the way they buy. So that kind of volatility of going up and down as dramatically as it used to, is not really as consistent now. I think we're more on the upward trajectory. That doesn't mean under certain market conditions, particularly where other kinds of capital markets like hedge funds come into play, like Berkshire Hathaway likes to play around in the edges of this, and it's a very big diversification for them. So just speaking on a capital sense, there are some ways that you can get a little bit of capital hedging to suppress this, but we are not in the world of that premiums coming right back down anymore because there are just too many disasters and too many high value assets that are exposed to them and that haven't had the mitigations developed. The only way we're going to see those prices go down in a significant and serious way is as we start to mitigate against that risk and go into that phase. And that's, as has been talked about already, it takes a while to A, get that mitigation done, and B, for the insurers to understand and trust it, and to start to factor it into their pricing models. Because, you know, you do one thing and that might, you know, let's say you put your house up on stilts. That's a good thing, but maybe it also makes it a little bit more expensive to do things like, you know, fix the air conditioning now because it's up on a stilt and you need a bigger piece of equipment. So they're kind of factoring in less flood damage, but higher cost to do that. So these prices are quite complicated, and I don't think we're in there. Is some volatility, but not the crazy volatility anymore, that where it'll go right down. So I'm sorry to say that to people, but you know, the other thing is that sometimes with the old shop around story, just be careful on that. If it looks too good to be true, it's because it is. You know, so what you see is maybe people think, oh, but my thing says flood, you know, and I got it for a really good price. Okay, but read what kind of flood. There is quite a bit of pressure at the moment to try and make insurance contacts more simple and more standard, and that's certainly something I think that groups like yourselves could really be activists for, so that if it says flood, it just means flood, and it doesn't matter where the flood came from. But otherwise, you'll come in afterwards and go, well, you've got riverine flooding, but you don't have storm surge flooding, or you don't have inundation flooding. You just want to know it's flood or it isn't. And, you know, it might be that you get a good price and it's got flood in it because it isn't the flood that they think you're exposed to. So I'd really, really encourage what Leanne says, really understand what you're looking at. Get a good broker who actually decodes what's in there for you, because that's what a broker will do. They will help you understand what you're really covered for. And then, you know, you can maybe make decisions even with your broker about, okay, if we're properly covered, do we want to change our excess? You know, so are we willing to say we only need to buy a product at a very high level? We can cover the lower levels, you know. So there's some things you can play around with there. But, you know, really where we are in this, I'm really sorry to say this, but you are at the cutting edge of the new pioneering things we need to do in insurance. And sometimes it's just nice not to be at the cutting edge, wouldn't it? But since you are, it's great to see that you're trying to do something about it.
Thank you very much. Jamie, thoughts? How's that sort of sit with you? Professor Paula, explanation where that sits as you in your experience.
Look, in the market right now, with respect to, I use the term hard and soft markets, and that's definitely a very old school terminology to essentially explain that a hard market means an insurer will generate a premium and it is not negotiable. What you get is take it or leave it, or you don't insure the item. That's a hard market. A soft market is, I got a quote, I can go to another insurer and get it 20% cheaper and they'll give me exact same cover and for the same risk. So a soft market means you've got lots of options. A hard market means if I get a quote here and go there, it's probably going to actually be more expensive all the same. I've got minimal options. My wallet, to reference, is out of options. I don't have many options. So what we're seeing right now in the commercial market space, this is across property and liability and things like that. We are seeing that markets are softening a little bit. Like Professor Paula said, they very rarely will go backwards. I'm in agreement with her on that. It would be very unusual to see premiums go backwards. A slow, steady increase that we can all adjust to is what we essentially need. How we come to that, that's a Professor Paula question, not for me. My job is to hunt around, provide, you know, very comprehensive advice, you know, to the mid-market sector on protecting their business, their assets. If it's a body corporate, it's about protecting the building, and you know, not just the building, but how many people are in that building. There might be 300 rooms. So it's not just a building, it's 300 people's interests that I need to consider when I'm making decisions on risk. Yeah.
Fantastic. I'm going to look for some more questions.
Bass,
Yeah.
sorry, Bass, I was just going to say, so I guess that, I mean, a question that is asked, and you've asked me this question before too, Bass, is then where to where you got the hard decision of take it or leave it. You've got this insurance. You're covered for all the stuff that, you'll be covered for, but flood's not part of it.
Yep.
This
What do you do?
this is where we're at.
Yep.
Yeah, so there are other isolated products. When I say isolated, they're not part of your program. They're not part of your policy. They're called parametrics. And Leanne, we've done a quote, I know, if you don't mind me saying, for flow, which basically will cover flood, at a certain level at that building, and you can insure for what value you seek. So there are products out there. For example, if you don't want to pay for flood cover because it's too expensive under your current program, you can actually get an isolated, what they call parametric quote, just to cover a flood event should it occur up to a certain sum insured. And if that ever happens, that policy will pay out. So it's like a little bit like that life insurance cover that we stick at the back of our kind of folder, and if it does ever happen, great. We've got that parametrics cover to pick up flood cover. This is where you can't, like in the main market where it says, and Leanne, you come to realize this last 2 years ago now, where you were getting sublimits, you were getting flood cover, everything was great. All of a sudden, and like you said, did they have a crystal ball? You and me are going to probably think about that, because it was that year they cut it off. 6 months later, the flood occurred. That was just good timing for them, in my view. They don't usually have, they do have models, but not to that level. That was just a freakish thing that occurred. I think we can all agree on that. And in that situation where you are turned away from all the body corporate, and something else to talk about body corporate, guys, I do want to bring up, there are other options outside the body corporate market. So in Australia, we have, dedicated body corporate insurers, but there's only about 6 of them. And when your strata title or body corporate person who's in charge of that goes and gets quotes, that's all they do. They actually don't go outside that space. There are other markets that can provide, covers for body corporates if you are in a position where you have exhausted your options. I just wanted to raise it that there's always options outside of the body corporate world if you do get stuck. And I'm, someone who's explored those on many occasions for different reasons. So it's not a take it or leave it. I just wanted to say that. Yeah.
And look, and just talking about parametric insurance, and we were offered that parametric insurance, but again, be very careful. My word of warning is, when you're not the expert, I got a bit of, advice from some other people as well. Like, we did seek that out. Unfortunately, they put that part of a parametric insurance, which Jamie could answer questions if anybody has them. But what we found was the levels, it gets to this level, you get a payout. But it's where they're taking their measurements from. And we know on our offer that we got, the measurements were taken at the Port Office gauge, which is totally irrelevant to the flooding upstream where we are. So yes, say if it reached, X amount of meters, that was at the Port Office gauge measurement. It probably was never going to get to that because it was already flooding up this end and we were going to be flooded, and it might not have reached that. And guess what? We flooded, but it didn't reach that measurement. So we wouldn't have been covered. So if other people out there that are looking at exploring those options, ensure that when you are discussing it, that you are looking at the numbers that are associated to where your building is situated. Be careful that you're not using gauge, that your fine print is not about, out at the mouth of Moreton Bay where it's already dissipated. Make sure that you've got your covers and that your sublimits. And this is where we got to the parametric question. And we just said that still is probably not going to suit us. And this small raising, so it led us back into this uninsured events fund. And I think this is where you have to be very careful then going down the body corporate path, because as committees and strata managers will advise, you cannot run a body corporate at a profit. You can have a sinking fund. So you have to put for your forecasting, and you must keep up with that sinking fund for your expenses to maintain and do all of these things, painting and, resurfacing your pools and, all of those sorts of things that has to happen, new carpets through common areas, equipment. But what we've done is underneath our sinking fund, we have put aside a special levy, which is called a special levy, a separate levy, which is raising that small amount. So spreading also the financial burden of all of the owners over a longer period of time, because as we know, people move and sell and come and go. So those owners may not be there that year or those 10 years that you're raising funds, they never got, we didn't have to call on that fund to use it. But it's really sad for the people who bought in at Christmas time, because they had, they wouldn't have had any money if we were just going to bill everybody at the time when it happened. So it's about raising that small amount for a longer program and a longer for the future events. And you need to put a lot of governance around that fund, because you don't want the committee to come in 8 years' time and go, oh, wow, you've got $500,000 sitting there in a sinking fund. Let's go and put a wellness centre on the roof. Or let's go and put, ping pong tables in the whatever. You make sure that you use that for uninsured events. And most likely that's going to be flood for this region. It could be, a terrorist act, because if you read your policy, terrorism's not covered in our policies either. So if it's deemed a terrorist act, you may need to have monies there for this uninsured, or yes, gaps. So it's covering and safeguarding the gaps in the insurance that you already hold. So I know we've gone, sorry, Bass, we've taken away from your leading us into questions and diverged ourselves, but it's kind of just, it's this conversation that kind of goes on and on down rabbit warrens. I'll let you take that.
Well, Professor Paula, just acknowledging your description of parametric in the chat for those who want to read it. We might park that complex topic to one side. In my head, given the complexity of what Paula has described as what's happening to the insurance market, given the complexity of what body corporates actually have to deal with in terms of insurance, we will see a profusion of mechanisms and insurance policies and a whole range of things as the market tries to address and give people some coverage. So this is a watch, this comes back to what Paula and Jamie are saying, which is you need to keep experts near you so you can effectively engage with this moment, because it is shifting and there are things popping up, positives and negatives. Listen, I want there's a couple more questions in the chat, but what I thought we might do just with our time is I wanted to sort of fast forward a bit, maybe 5 to 10 years from now, Professor Paula. Where will we be, I guess, in 10 years from now in the insurance market? And then I actually might ask Leanne and Jamie, where do they see it going in 5 to 10 years from now as well, this sort of era? Because I want people on the call to sort of understand, when they go away from here, there are actions that they can take through the Resilient Kurilpa website, the templates and stuff. But we are interested also in supporting residents on a long-term basis. And so hearing about what people see coming long down the line is very valid, I suspect.
Yeah. Okay, so let me give you my best case and my worst case scenario. So the worst case scenario is the do nothing scenario. If we do nothing, we will have a bigger and bigger swathe of uninsured people throughout Australia. And that that means that the insureds will also be a smaller pool. So the price will go up for them, even if they're not such high risk. And that will have knock-on effects on our economy, because you need insurance to get and maintain a mortgage. Increasingly, banks are coming to that party and going, hang on a minute, I need these assets that I am loaning a 25-year mortgage on to also have the capability to stay insured for 25 years. So if we do nothing, we're kind of heading for a bit of a catastrophe here. It's a slow-moving one, but it's moving a little bit faster every year. I'd like to think we're not moving towards that. So I'm going to give you my best case scenario. We are rolling out a lot of disaster resilience funds of different kinds at federal and state levels. My best case scenario is that we really understand what those do, that we don't just do some rollout of them and then we go away because, we don't have a flood for a while and we forget about them and we don't check that they're properly maintained, because the mitigation must be maintained. Like if you think about, for example, putting in a house on stilts. If somebody buys your house in 4 years' time and goes and builds a beautiful new kitchen downstairs because look at all this great space, they had the problem that we just mitigated against, So if we can maintain the database on the mitigations, if we can check how they actually work in the face of disaster, then we have a powerful argument for maintaining or growing an insurance market, either privately or most likely a public-private partnership of some type. I expect, while there is no government word on this or anything about a flood pool, somebody did ask about that, national flood insurance. It's a common response to things like this from the moment that the cyclone pool consultation started, I think in 21. It was in 21, might have been 22. There have been calls for a bigger pool, a flood pool and a multi-peril pool. So MPs have been asking for it. Consumer lobby groups have been asking for it. It is a response that is taken around the world. Therefore, it's reasonable to think we might have one. And it's most likely going to be, if we do have one, that thing will tie into mitigation if it's well designed. So my best case scenario is we don't have a better situation in terms of climate, but we don't have a worse one because we've managed the climate a bit better. And we've started changing the vulnerability of our assets. Okay, so we've started making them more resilient to the disasters. We've relocated where we can to the people who we just can't make more resilient. And all of that lessens the overall risk profile of Australia and lowers the costs of losses. And when we do that, then we can get a national pool that can actually keep prices down and where the private market can participate. So my best case scenario is we go for the joined up approach. So, lobby for that as well. And chapter 5 of our book talks about that, how you kind of use these things to create a more resilient ecosystem. So it's not just about insurance, it's a resilient ecosystem. And that's the research I'm doing right now. So hopefully we'll have a little bit more to say about that and what we can do about it.
Thank you. Leanne, 5 to 10 years. Where's your vision?
I hope that in 5 to 10 years, as more and more buildings are being approved, and that's this high density living is the way of the future. We've run out of land. We have no choice. You can see every time a house comes up for sale, even in the suburbs, developers are putting up more high density residential. So we do need to start engaging and being more proactive with learning how to live in this type of environment. And what comes with that is this understanding of your risks of where you live. So you need, it's the Kurilpa region, Brisbane is on a floodplain anyway. That's we all know that. That's why we have dams behind us to mitigate that from history. But is to hopefully we're going to be more proactive in our ability to understand how we can afford to live with, obviously insurances and things like, can we make ourselves more resilient and mitigate our loss, and not only just financial loss. It's that mental, these events, seriously affect people's lives, their possessions, their personal, right down to that personal level. It's awful seeing people's personal possessions sitting in a big pile of mud and rubbish on the street for the bulldozers to put in the bin and take to landfill. It's horrible. We should never, now that we've seen this and we're obviously asking people to be more proactive and start thinking about this, is to prepare. And let's hope that in 10 years' time, if we have another flood, which I'm sure there'll be an event of some sort, it's not a 1 in 100 years, it is going to be the future, that we come out of it so much more resilient and so much more prepared, and we do what Professor Paula said, we turn that around faster, we get back into our homes faster with less, financial and health, burdens. That's where I'd like to see it in 10 years' time.
Powerful stuff. It involves 56 plus high multi-unit residential buildings, and growing in the Kurilpa region, coming on this journey of risk and insurance. The sheer level of intellectual energy and time, effort required to build this is substantial. So
Yeah.
as Leanne says, our goal at Resilient Kurilpa is to help groups do this properly and to link up with different things.
And
Jamie,
engage with the government
go on.
bodies too. Sorry, and engaging with the government level, the planners, the the DAs that are going through, making them, think about that not the Q100, the Q20s. Well, where are those services? What is going to happen? And making sure that they guiding people into understanding, their buildings properly and what can they do, instead of just building and going, there you go, move in and we'll just keep going to the next building. Getting at that government level or your council, local, state levels in all parts to actually address these issues and think about how we live through them. What can we do to help everybody understand this situation? Sorry, that was my extra bit.
No, it's fantastic. I mean, what we've seen, you and I, Leanne, on this journey has been just that, even that mindset of moving from house, tin and timber, raisings, things like that, into a body corporate mentality of buildings worth hundreds of millions of dollars, getting insurance. And you can even see the government has had real trouble understanding that that's actually a real reality, which is we have built in the last decade or more these incredible buildings, which are now part of our risk profile.
Mm-hmm.
It is not just, can we raise this up on stilts? Like, we have moved into detailed engineering and design to make these more resilient.
Yeah,
So
and
it is a journey for everyone.
Yeah, and hoping attitudes change as well. I think we need to move past the attitudes of I'm insured. This is what we all have all heard this. I'm sure everybody on this chat who went through the 2022 floods had heard somebody say, it's okay, I'm insured. I don't mind if, whether it was my car or my belongings, it's insured. We have to change this mentality and attitude. And I'm hoping that in 10 years' time, that this is what I was talking about, mitigating your losses and mitigating and preparing for that. Make sure it's just because it's insured doesn't mean you have a right and entitlement to let somebody else pay for it and don't do anything. Do you know, it's kind of like you've got it insured because it's a personal possession. That doesn't mean that if it, you get something new just because it got, if it happens, yes, that's fine. But be proactive in making sure that you try not to have a loss because, that's going to bring the premiums hopefully more affordable too, instead of just letting it be a lazy attitude. We do need to change. We do need to change our cultural way of looking at insurance as well.
Yeah, it's not just it's not just someone else's money that we get whenever we feel like it. Jamie, 5 to 10 years from now, how should we be thinking, in your view?
Look, unfortunately, the history has taught us that we are learning, but at a very slow rate. As of today, 83% of Australian households, according to the Insurance Council of Australia, are underinsured and not covered for their value. There are simple tips and tricks that people can do, and maybe a bit of takeaway for those that are on here, as well as those that might tune in the future. If you go to the Insurance Council website, there's a calculator there provided by Cordell, which you can get a building replacement cost right now on what your home's actually, would cost to rebuild. They have a disclaimer there saying we don't factor in, something that might occur in a year's time or 2 years' time. But as of today, this is what your home is worth. That's just one tip that could be so simple for somebody who's never really understood the value of what, replacing their home is worth. In the personal or domestic market, there's no underinsurance clause, and this is a problem, in my view, Professor Paula, because they did introduce it, and you might remember that in the 80s. Underinsurance means that if you don't, it's a clause written into a policy in the commercial. This is alive today in commercial space. So if you have a commercial building and it's worth $100 million and you only insure it for $50 million, it's only insured for 50% of its core value. Now, if there was a claim and a total loss, not only would you not get the 1 million, you would get 50% of the 50% of the 50 million, which would be 25 million, because that represents a underinsurance value of 50%. Do you know how many people have no idea that exists? It's just something so critical like that. It boils down to education. I'm in that industry, which is fine. But people that are in business, I do always try and educate them and say, look, I don't think these values represent the replacement cost of this building. We need to get a surveyor in, and we need to make sure that this is done right. As a broker, that's my job. And you do understand as well that although we give that advice, we can't make people accept it. Sebastian, back to your question, in 5 to 10 years' time, what does it look like? I see the government implementing a flood levy through insurance premiums at some point in time. That is my view. It's worked very successfully, and again, Professor Paula, you can probably support this with the ESL down in New South Wales with the fire. Sorry, that's the emergency service levy. Then they had the FSL levy. It has worked incredibly well for those losses, catastrophic losses, due to the fires we have every year down in New South Wales and Victoria at times. So if you were to ask me how the government is, if they were going to step in and what they were going to do, I see a flood levy being imposed, because it's very hard for the government to have an underinsurance clause on private property. Unfortunately, they did try it, but it failed. People were just unable to value their homes, and it was not in the public's best interest to hold them accountable for that. So therefore, it was scrapped. However, it is still alive and very well today for any commercial property. Now, just keep in mind that includes body corporate. The underinsurance clause does apply to body corporate, even though we sit there and go, oh, well, this is a domestic market, kind of, because it's residential, right? Body corporate falls into a commercial product, guys.
You got buildings at 65, 80, 100 to $300 million worth.
Correct. Yeah.
And if you're only insuring for, like you said, it's a $100 million building, and you think, oh, well, we can get away with an $80 million, because you have to think about, like in the event of a fire, if you have to dig out your foundations. I mean, it's right down to ground zero. Whoops.
Then you got you've got the demolition costs. You've got council approval. Plans need to be redone. All the civil's got to be there's a lot of things that, if you want to go down to a finite point, there's a lot of things that, as a broker, we do educate our clients on those things when we sit down and talk. And that is the pure purpose of our job and our role, is just to give people the warning signals. What they do with it, it's their business. All we can do is provide that help and that advice. But it's their decision at the end of the day. We take their instructions. Thanks,
Paula, you've got your hand raised. Maybe you might just speak on the point that you wanted to chat about.
Yeah, just very quickly, this issue of the underinsurance is an important one that people aren't aware of, in that sense. But one of the things that I think we will see, and I hope we'll see, is a more flexible approach, so that actually people, because there's always mistrust on both sides after a disaster, right? So everybody suspects the insurance industry of price gouging by putting the premiums up. And the insurers expect all the people who are fully insured that they're price gouging by getting a little bit something nicer than they really had and doing this sort of thing. So each side is inflating the situation. But if we were to take a much more realistic appraisal of risk and say, okay, what's what I really need to make good again? I don't necessarily need to have a brand new kitchen and a great new oak floor, although that would be nice. But what do I really need? Then that also would help us to bring prices down. And if we could come at that as that's not underinsurance, that's specified insurance. And I think that we might be starting to see somewhere in the next 10 years a more realistic approach to that. Parametric operates somewhat on that basis of a chunk of money to make good. It's got lots of conditions. But I think, Jamie, there is also room in this notion of what is underinsured versus what is the requisite amount of insurance, because people like yourselves, Leanne, are actually doing a lot of work to know what self-insurance means. And it may be that you don't need full full replacement for certain things, and you could therefore get that at cheaper cost. So I just hope we're working in this space of a more trusting and more trustworthy set of relationships around risk as we get to know more. But I'll shut up because actually it's the people on the call who need to do the talking.
Well, actually, I think that might be a strong way to finish tonight. We've heard tonight from Paula and Jamie and Leanne about the experiences in all these sectors. What we as Resilient Kurilpa, what I wanted to show you is that we as an organization and the people on this call are thinking very deeply about these questions for our community. And we, as you heard, there are no straightforward answers, but that education and engaging experts and going on the journey is the only way that we can build resilience within our community. That's scary. That's scary. It takes effort. It takes energy. It's having hard conversations. It's about being honest and open about risk within sometimes environments where people don't want to hear it. They don't want to hear that their place is at risk, that there are real risks here. But the opposite of ignorance leads to greater catastrophes, and it has longer term impacts that are really challenging. So this tonight has been a really, really, really powerful set of conversations, because it is the start and really the ongoing journey of how does resilience be embedded in our community of Kurilpa? What lessons can our residents take? What lessons can people who are joining from everywhere else in the country take from this discussion? And when we look back, I fundamentally believe we will only have built resilience by not just, infrastructure and government pools, but by going on a long-term journey of actually driving education and knowledge and understanding. And that's what Resilient Kurilpa is really powerfully trying to do. Because we're coming to a close here, I actually just want to quickly put up a slide that shows the other events that Resilient Kurilpa will be holding into the end of this year. So fantastic. I also note that the email addresses of Professor Paula, Leanne, and Jamie are also available. If you'd like to take them down, we'll put them in the chat as well. The next couple of events which you can register for, one is psychological first aid training for flood volunteers. That is powerful. We, as an organization, Resilient Kurilpa, recognize that one of the most important things that communities do when they are first responders, and we know that within disasters, our community is the first responder. We are the ones who go to people's neighbors as the floodwaters come, and we are the first ones there, usually scraping mud out of the basements. But there is psychological first aid training available for people who'd like to join and learn how to not just help people who are going through disasters with moving their stuff and being evacuated, but also the psychological and mental impacts of disasters. So that's a really powerful thing. And then we have a series of flood planning conversations coming up where we're actually going to bring community into a physical space at South's Rugby League Club in Kurilpa, down in West End, and we'll actually have discussions about flood planning on a more macro level. So about the elements of what planning does and how networks can work to support flood response, but also reducing our risk. So I actually just want to firstly extend my thanks, Professor Paula, Jamie, and Leanne. An exceptional conversation here tonight. It's been recorded for posterity. We had a number of people say they're looking forward to the recording. The recording will be sent out to all those who registered. It'll be available on our website, resilientkurilpa.com. It'll also be available, that will actually be through our YouTube channel. There are a number of recorded webinars on knowing your building's resilience, knowing your residents. The first aid training will be there. This will be there, and also renters' rights as it applies to those who are flooded. So what to do if you're renting and your building is damaged by floods. So please very much access our resources. We also have flood risk templates. We have a library of 175 knowledge cards, which is all about resilience and flood resilience from a whole different perspectives. yeah, so thank you very much for joining us. Greatly appreciate sticking around on this day for the full session, and we'll have more conversations. So, and we'll have more resources. This is just beginning. So please keep with us. Thank you very much.
Thank you.
Thank you.